Welcome to Market Overtime. I'm Diane King Hall at the New York Stock Exchange. There's been no shortage of news in markets to begin the new year as a new administration, tariffs, and the DeepSeek model have investors and traders on the edge of their seats. Our guest today is one of the most respected names in finance and the author of a new book, The Psychology of Leadership. I'd like to welcome in Sébastien Page, Head of Global Multi-Asset and Chief Investment Officer, T. Rowe Price. Thank you so much for joining us today, Sébastien. Why don't we start out big picture and talk about your outlook for the economy in 2025? What is it?
Well, first of all, you just said investors are on the edge of their seat. I'm not. I'm relaxed about the economy. Look, the economy is doing just fine. We're looking at about 3% GDP growth. And add to that 2.5%, 3% inflation, that's 6% nominal growth. If you compare that to any year between the global financial crisis and COVID, it's higher than any of those years. The economy is growing at a fairly fast nominal pace. Otherwise, the data looks good. The economic surprises are positive. We've got good numbers on retail sales, on industrial production, upward movement in manufacturing, the consumer looks strong, and on and on. The economy is doing just fine.
Okay, the economy is doing just fine. I feel like there's a but under the hood. And before we get into that, you describe yourself as a reluctant bull. I know you shared that with us. You shared that with us offline. I've seen you talk about that in interviews. What does that mean, and why do you describe yourself that way?
So, I wish I had a view that's very different from the consensus. The consensus is that the economy is doing well, and most investors are comfortable for the next 6 to 12 months. However, the consensus is also that valuations are quite elevated. And that's whether you look at stocks or even credit spreads. And there are signs of speculation in markets generally, hence the reluctant part, right? Okay. I like the economy. Earnings are expected to grow 15% for the next year, but I'm looking at valuations and I'm getting a bit reluctant. Our asset allocation committee is actually starting to shave off our overweight stock position. We're slowly sort of paring back, taking some profits. That's the reluctant part.
Okay, so that's the reluctant part because valuations are stretched, and you're not the first, obviously, to make this point. So what are you doing? What changes are you making when it comes to allocation as a result of that?
So as we're selling stocks, we're actually putting the money into cash rather than bonds. So we're short duration. We're also selling some high yield bonds, and we're splitting the proceeds in half. One half in cash, the other half in bank loans, which tend to do well when rates surprise on the upside. So that's a good way to diversify your portfolio. For example, the bank loans did relatively well in 2022 when rates definitely surprised on the upside by a lot.
When you talk about, kind of moving into cash, is the idea there to be able to take advantage of opportunities that present itself because you have the liquidity, especially if the valuations, when you think about equities, do a reset?
Yes. And, it's dry powder. But I just want to say, though, this is an environment where I think finally diversification can pay off. I think having a broad set of exposures, including value stocks, gives you some defense in the portfolio, all else equal. By the way, if you look at the last 200 trading days, value stocks, 17 out of 17 times when the S&P sold off by 1% or more, outperform growth stocks. So they're behaving defensively. They've been underperforming growth stocks. But today, when I look out for the next 6 to 12 months, I like having the somewhat of a downside protection in stocks with the value style. And my view is probably similar upside as growth stocks from here.
Do you think, I know the hope coming into this year was that we would see more broadening, especially when you saw so much concentration over the past couple years in tech. I do think, I know as we saw some of that this week, especially when you saw some of the outflows and where the inflows were, you saw some inflows in particular into financials. And I know that's expected to be a winner, especially under the new administration. Are you prepared for any surprises, or how are you preparing for surprises?
My dentist often asks me for investment advice. I don't know if you've noticed. If you're in the investment business, dentists like to, you're in the investment business, what should I do? And I always say stay invested, stay diversified. When you don't have time, that's what you say. It's trite.
Right.
I think, however, in this environment, it's more salient, relevant than ever because you do want to be invested. As I said, the economy looks fine, earnings are growing, the Fed's accommodative, there's plenty of liquidity, so be invested. Own some growth stocks for the long run. Tilt tactically towards value. In our view, shorten your duration, can have that cash buffer, but then stay diversified. And this is where I think finally, you're right. We've been talking about the market broadening.
Yeah.
I think we're at a moment in time where we're probably approaching peak concentration.
Okay. Okay, so approaching peak concentration. Let me ask you about a little bit more about that because you saw the market get rattled recently by this DeepSeek.
Yep.
I don't know if shall we call it innovation, because the jury is out about how much we should make of some of the details we've heard so far. Was it really 5.6 million? Were these authorized chips? Were there, kind of workarounds in terms of them receiving them? What does that mean in terms of what's been going on in this AI arms race? How do you view that in terms of, especially when you think about valuations within the tech sector?
It's been a fascinating story to follow this week, and maybe it can be a little bit of a catalyst for that rotation, but I also think there are other factors that are going to drive that rotation. More cyclicality in the economy, lower taxes, deregulation, higher inflation pressures, and so on. Those are all macro forces that can help the broadening of the market. But the DeepSeek story in particular is fascinating because it does seem to show that the need for those super high-end chips that you absolutely need to develop large language models is potentially lessened. What's interesting, someone said recently to me that there are too many financial analysts right now that are all of a sudden technology experts and large language model experts.
We all had to become LLM experts overnight.
Yes, but let me say this. We have 300 analysts at our firm, and deep fundamental research is what they do. And one of them is he's built his own LLM. So, I talked to him. And what's interesting, what he's saying is a lot of these developments, most people that are really in that space saw them coming.
Yeah.
Because you had trends in terms of using models sparsely, using just a little piece of the model, or trends like, they call it distillation. Again, I'm not the tech expert, but what I'm hearing is this distillation is you're using a larger model to build a smaller model more efficiently. It maybe shouldn't have been that much of a surprise.
Right.
It's where the puck is going. I'm Canadian. We're going to use a hockey analogy, if you can indulge me.
We'll allow it.
So we're still optimistic about the AI space in the medium term.
Was the AI sell-off overdone in your view?
Look, there's a lot of dip buying already. Given the starting valuations, I'm not sure. I don't want to say overdone because I call this the tyranny of high expectations. The expectations are just so high, not just in terms of the spending to build those models, which there's no sign this week that this is actually necessarily slowing down for now.
It didn't. We saw no change in terms of the spending from big tech. Like Meta didn't make any changes to its spending allocations, CapEx allocations for 2025. I mean, all these companies were asked about it on their earnings call. They addressed it, but it didn't sound like they were making any changes with regard to their CapEx plans.
Yeah, and we'll see. It's a race. There's a winner-takes-all effect in technology, and companies like to be at the very cutting edge, and as far as I can tell, right now to be at the very cutting edge, you still need those cutting edge chips to make it happen in massive investments. Now, it's evolving. It's definitely evolving. But your question, is it overdone? The expectations are just so high in terms of how these stocks are valued and in terms of what it's going to do. So in the short term, it could correct and broaden. Again, in the medium term, you can potentially have higher expectations in the medium term of what this could really do to productivity, because then you have cheaper development of applications, and then that can impact healthcare and so on.
I want to go back to your point about the concentration and expecting to see more broadening. What are the signals that you're looking for to be prepared for that and to be tactical around that?
So we're looking out 6 to 12 months typically in our tactical moves, and we try to focus first and foremost on the relative valuation. We want to take advantage of asset classes that are attractive from a valuation perspective. But as we all know, you need a catalyst.
Yeah.
And a lot of those valuation models have failed over the last 10 or so years because you really need to see a catalyst. The catalyst, I think, in part is this new administration, so the macro policies.
Right.
I think it's a broadening of the fundamentals themselves. Financials, right now, year over year, their earnings are growing at the same pace as technology, if not a little bit higher.
Right.
So the broadening of the fundamentals can lead to the broadening of the market itself.
Is there a structural advantage that you see to value in this year, and especially over the next 6 to 12 months?
I think so, and as I said earlier, it feels like value has been defensive. It tends to do well when there's inflation, when commodities prices go up. Commodities are highly unpredictable, but it's kind of a hedge from that perspective. We also have an overweight to real asset equities, which tend to classify as value as well, but are directly inflation sensitive. I'm not saying we're going back to 8-9% at all. But I'm saying that if I look at inflation swaps for the next year, they're at about 2.6%. The risk that we surprise on the upside relative to the downside to that is higher. So we like, those could be the catalyst for value to do well. And so on the margin, there's an advantage. It's not a huge position, but we're tilting that way to just capture the opportunity here.
Understood. So when you think about inflation and the road ahead, I think one of the wild cards has been what's going to happen with the new administration. Well, I guess the biggest wild card, especially when it comes to tariffs, and what tariffs will be, where they will be enacted, and the sequence of those. Does the fact that, kind of bracing yourself for tariffs matter more, or is it about the sequencing to you?
I'm fascinated by your business, by the news business, because DeepSeek was big news early in the week. And now we're towards the end of the week, and it's tariffs, and it's 25% on Canada and Mexico. And I'm not saying that lightly. These things matter, but things change quickly. In the tariff space, there's a tariff game, if you will, being played right now. When I look at inflation in general, there's one piece of good news which we should not ignore, is the fact that the latest data that has come out on rents for new tenants is actually net down.
Oh, really?
And that is a huge component of the core inflation. However, when I look at everything else, and if we put tariffs on Canada and we import all this crude oil from Canada, it's got to be inflationary, at least in the short run, even to commodities prices. So everything else outside of those rents coming down, to me, has upside risk. Goods disinflation kind of running out. Look at what used cars have been doing for the last 3 months. They're actually going up at a 20% annualized space. So the goods disinflation is kind of running out. Services outside of housing, it's really, there's a lot of price pressure there. Airline tickets or insurance costs. There's inflation pressure there. Wages are growing at 4%. So that's the cost of delivering services, right? You need to employ people. So all these things makes it hard to convince yourself that we'll be at 2% anytime soon.
Right, that's fair. And because the latest PCE numbers at this point that we just got, especially when it comes to core, 2.8%. So it seems to me, in the case of the Fed's recent decision, which they signaled ahead of time, that makes sense. Let me ask you a little bit more about your positioning when it comes to fixed income. You said you're short duration. What is the trigger to change how you allocate there?
Yeah, look, there is value in fixed income. And when I'm asked my opinion of deploying cash over time, I think it's interesting to deploy cash in stocks and bonds, in diversified multi-asset portfolios. Happens to be the business I'm in. Okay, maybe I have a bias there. But so bonds have some yield, and they use not to for quite a long period of time. When we dig into the fixed income positioning and our views on fixed income, we actually think credit could do just okay. The spreads are so tight, right? Everybody agrees that the economy is going to do fine. But if you actively manage your credit exposure, you can have an overweight there. I mentioned we like loans, so we're adding to loans. The cash earns you over 4.5%, so that's nice. And then the treasuries themselves, the long end, the catalyst for us to start buying those, in my mind, would be 5 or above.
Okay.
Where the value becomes so compelling that you start looking at it. I don't have consensus on my asset allocation committee on that. Some bond bears think we're going even higher, and that we we'll see when we get there.
Yeah. Do you share similar views to that, or you think that's too bearish to take?
I mean, we have debates. That's how committees work. Right? We want the best ideas to surface, and the best way to refine your thinking is to look at both sides of an argument. So we have these discussions nonstop. We don't call them disagreement. We don't call them fights. We call them constructive debates.
I like that.
So we have the constructive debates on when would be a good time to start buying treasuries, start buying durations, and how high rates can go from here. And look, some on the committee think they could go much higher. Others think, it depends why it's going up as well.
Okay.
Right? Is it going up because growth is picking up, or because inflation is picking up, or because deficits are becoming so massive that at some point treasury buyers start to balk? I'm not talking about a Liz Truss moment, UK equivalent, because people really want US treasuries for safety, at least still. But those are different situations. And if you start to go higher because of growth or inflation, and you think those are forces that are going to fade over time for some reason, then you start and buy the bonds.
Okay.
Again, we still own bonds, we're just underweight.
Let's talk a little bit about this stronger dollar that we've seen. We've seen it pull back a little bit. How much of how difficult is that? There's an argument that we've continue to hear about the exceptionalism in the U.S. The U.S. has been a leader in terms of assets and equity movement compared to overseas markets. At the same time, a stronger dollar does make it difficult. How much do you pay attention to that? How much does that matter?
It matters way more than people think when you allocate to non-U.S. stocks or non-U.S. bonds. It ends up being a significant part of your return as a U.S. investor. So we pay close attention to it. Tariffs are part of what explains dollar strength, because if you're a receiving country on the receiving end of a tariff, you can cheapen the goods by devaluing your currency. Right? So you put the goods on sale by bringing the currency down relative to the dollar. But there are other forces. To the extent that the U.S. continues to grow faster than the rest of the world, strong dollars. To the extent that the rest of the world is cutting rates faster than the U.S., strong dollar. So all these factors are converging to at least stable or strong dollar.
And I want to ask you about your book, The Psychology of Leadership. Tell me about some of the core principles that you talk about in the book.
So the book is about setting goals, executing your goals, and then bringing people along. And when I look at our business, for example, I talk about something called core beliefs, which is how you interpret the world around you. Think of people who are pessimistic. They have a core belief that the worst is going to happen. The sky is falling. Yeah. So that's a core belief. In investment management, we have core beliefs, right? Some people think the trend is your friend, and that's worked quite well. That's kind of a core belief. I see things going up, I want in. A core belief we have, and it's part of how we're trained as financial analysts, is that valuations matter. And we were just talking about this. Well, when I look at this idea of core beliefs, I think we're at a moment in capital markets history where at some point valuation has to reassert itself as an investment principle, as an investment core belief. And we might be at a turning point there. So this is just an example of how psychology helps, positive psychology helps for so many things. It's so underrated in the business world. That's why I wanted to write the book.
No, I appreciate that, especially because, I've started to see that chatter that we used to have once upon a time about animal spirits returning to markets. And that feels like that's in line with what you're talking about, the potential for a shift now. Any final thoughts that you want to leave with our audience with regard to the investing landscape and your views on it for 2025?
I think we'll be just fine. Speaking of core beliefs, I like to be an optimist. The economy is doing well.
So am I.
Markets should broaden. And as I would tell my dentist, stay invested, stay diversified.
Stay invested, stay diversified. That's your parting message here on Market Overtime from Sébastien Page, Global Head of Multi-Asset and Chief Investment Officer, T. Rowe Price. Thank you so much, Sébastien. Thank you all for joining us. Market Overtime has new episodes each week on SchwabNetwork.com. You can find the full archive on the Schwab Network YouTube page. I'm Diane King Hall. Thank you again for joining me.